Good day, students. This is Professor Buckholz coming to you with our chapter today on Chapter 11, Internal Control and the COSO Framework. So again, we have several different learning objectives here. The first is to describe the three primary objectives of effective internal control. Second, to contrast management's responsibilities for maintaining internal control with the auditor's responsibilities for evaluating and reporting on internal control. Number 3, explain the 5 components of the COSO internal control framework. Objective 4, explain how general controls and application controls reduce information technology risks. 5, identify the types of information technology systems and their impact on internal controls. The first objective, describe the 3 primary objectives of effective internal control. So again, ladies and gentlemen, if you work for a company, you're going to notice that if you have a system of internal controls, it's designed to provide management with reasonable assurance that the company achieves its goals and its objectives. Now, basically, the 3 main goals of an internal control system is reliability of reporting, that when you get a financial statement, it basically has good, credible numbers. That's reliability. The next thing is that we are effective and efficient with our operations. If we've got 2 people doing the same exact job, that is not an effective nor an efficient use of our time. The last thing, compliance with laws and regulations. Laws and regulations. In plain English, what does that mean? It means that we are compliant with all the human resource laws. We're compliant with whatever rules and regulations are coming out. So that's something that's important. And again, a good system of internal controls will ensure that. Internal controls are the client's responsibility. That is not something we, the auditors, make up. Management is supposed to be doing that themselves. Second objective, contrast what management's responsibilities are for maintaining internal control with the auditor's responsibility for evaluating and reporting. So again, management has responsibility, as we just mentioned a moment ago, to establish internal control. Management must establish and maintain the entity's internal controls. Now, internal control systems are designed with 2 concepts. Number 1, reasonable assurance. Management designs a system that provides reasonable assurance considering the costs involved, meaning, as we've seen in this course, there's perfect systems of internal controls. However, they are expensive. So, if for the sake of argument, if you recall from financial accounting, the cost-benefit principle, if the cost of something is $20,000 and the benefit is only $10,000, it would mean to do it the right way, we'd be out of pocket $10,000. And that doesn't make sense for management to do that. So there needs to be that old cost-benefit consideration. Inherent limitations. No system of internal controls can be completely effective. Keep that in mind. We can spend billions upon billions of dollars as a company, and the controls may be very, very poor. Effectiveness depends on the competency and dependability of employees. Ladies and gentlemen, we can have excellent internal controls, but if somebody is not as educated, if somebody's not fully familiar in internal controls, you can have inherent limitations that your internal controls will not function as they should. And I hate to say it, but collusion is still a possibility. So we have management and auditor responsibilities for internal control. Again, under the Section 404 reporting responsibilities, or SOX, Sarbanes-Oxley, it requires management to issue an internal control report that includes the following: a statement of responsibility and an assessment of the effectiveness of internal control over financial reporting as of the end of the fiscal year. So again, it's two things here: statement of responsibility and an assessment. Management must also identify the framework used for the evaluation. And usually the one that they'll use is COSO, the Committee of Sponsoring Organizations 2013 Internal Control Integrated Framework, which we're going to learn about shortly. Management's assessment of internal control over financial reporting consists of two key aspects. Number one, management must evaluate the design of internal control. Management must test the operating effectiveness of those controls. The SEC requires management to include with its annual report, which is the 10K, another report on internal controls. And let's look at an example of this, of what management reports. Now again, the report you're looking at on your screen is, again, Section 404, Sarbanes-Oxley, Management's Report. And you'll see a couple paragraphs here. First paragraph that says, we as the management are responsible for establishing and maintaining adequate internal control over financial reporting. Marble's internal control system was designed to provide reasonable assurance to the company's management and board of directors regarding the preparation and fair presentation of published financial statements. Marble management assessed the effectiveness of the company's internal control over financial reporting as of December 31, 2016. In making this assessment, it used the criteria set forth by the Committee of Sponsoring Organizations of the Treadway Commission, COSO, in Internal Control Integrated Framework. Based on our assessment, we believe that as of December 31, 2016, the company's internal control over financial reporting is effective based on those criteria. Marble's independent auditors have issued an audit report on our assessment of the company's internal control. That report appears on the following page. So again, management makes their assessment, and then as we'll see, the auditors also make an assessment as well. Our assessment is to understand and to obtain an understanding of internal controls relevant to the audit. What are we concerned about, folks? We're concerned about controls, internal controls over the reliability of financial reporting. We're also concerned about controls over classes of transactions. Those are the two we are primarily concerned about. Our responsibilities is that we need to issue a report on the effectiveness of internal control. So again, when we do these types of engagements, ladies and gentlemen, we're not talking a short engagement. We're talking a very long engagement where we're testing all the controls. No. We're going to test only those controls that we feel have a direct and significant impact for our organization. So we'll look at risk assessment and say, well, is the internal controls over prepaid insurance something we want to look at? No. But we're probably going to want to look at something related to revenue recognition. That's a big one. The third objective: the 5 components of the COSO internal control framework. So COSO has an internal control, an integrated framework. And it was developed in 1992 and updated in 2013. So the COSO has 5 basic components that we want to learn about: the control environment, risk assessment, control activities, information and communication, and monitoring. The updated COSO framework includes a total of 17 broad principles that provide guidance to support all three internal control objectives: reporting, operations, and compliance. Figure 11.2 talks about the COSO framework. Now again, 2013, the COSO framework was revised, so we'll see the 5 basic components in the front, and then notice how the new COSO framework kind of gives a cubic form, talking about operations, reporting, and compliance within the entity, the division, the operating unit, and the function. So let's talk about each component of COSO. So the very first element of COSO basically says the control environment, and it consists of the attitudes, policies, and procedures, oftentimes called the tone at the top. What is the tone at the top that management has? Does the corporation that we're auditing have integrity and ethical values? So again, are they a bunch of crooks? If they're a bunch of crooks, it's somebody we don't want to be associated with. We don't want to have that responsibility. We don't want that anymore. Board of directors or audit committee participation. Does the board have regularly scheduled meetings? Do they get financial statements in advance? Do they question those statements? Do they meet with the auditors? What is the organizational structure? Is it clearly defined? Does the organization have something called a table of organization that everybody knows what they are doing? Is there a firm commitment that we hire competent people that know accounting, that know bookkeeping, that our CFO knows what's going on? Is there accountability? Is everyone accountable for their actions? Again, these are things as the auditors we're going to look at and we're going to assess, and if our company doesn't have it, we've got a problem. And what you'll notice in the next figure is that the control environment, as it says, serves as an umbrella, an overarching umbrella, which basically shows all the information with risk assessment, control activities, information and communication, and monitoring. COSO components of internal control continued. Risk assessment. The next step is risk assessment, and that's really a process for identifying and analyzing risks that may prevent the organization from achieving its objectives. So again, what is risk assessment? It involves management's identification and analysis of risks relevant to the preparation of financial standards in a conformity with appropriate accounting standards. That's risk assessment. Meaning, as a company, do we sit down and identify where the risks are for our organization, whether it be internal controls or business risk, ladies and gentlemen? We're a company who manufactures, let's go to an old category, horse whips, horse buggy whips. Well, as we know, there's not a lot of demand for a horse buggy whip. So if I'm in that business, I may want to look at a different strategy going forward. Otherwise, I have a risk that my business may not survive. When we talk about this risk assessment, we're talking about having some clear objectives, how the risk should be managed. Let's consider the potential for fraud, and let's monitor the changes. Control activities. Control activities really are those accounting policies and procedures that, again, allow us to do certain things. We're going to write out a check for accounts payable. We're going to pay a bill. Well, let's talk about all the steps that go along with that. That's a control activity. When we get an invoice, again, in our accounting careers, we're kind of biased because we've been taught to believe when we get a bill in, we debit expense, we credit accounts payable. And that is the correct journal entry. But that's not the story. That's not the end of that story. What is the underlying tone there? Well, when I get a check, an accounts payable bill, it's got to be analyzed by the accounts payable clerk. Where does it go? Where does it get coded? What department? What category? Have we received the goods and services? It's checking with our receiving department. What else does it involve as a control activity? Did we pay the bill on time? Was it approved properly? Someone's got to approve that bill before we pay it. When it's paid, who mails it out? How does the bill get decided when it gets paid? And then lastly, filing that bill. So there's a lot more steps in there than just debit expense and credit AP. There's more. And control activities, what are we worried about? Developing control activities that mitigate risks. There's always a risk, we know that. But in good internal control should mitigate that risk. Developing general controls over technology and establishing appropriate policies, procedures, and expectations. When we talk about control activities, typically we have 5 special buckets that we've carved out. Number 1, adequate separation of duties. Number 2, proper authorization of transactions and activities. Number 3, adequate documents and records. Number 4, physical control over assets and records. And number 5, an independent check on performance. So let's talk about each of these in a little more detail so we understand. Separation of duties. So again, a good separation of duties really would, at this stage of the game, allowed us to do 4 different things. And also, we hope, prevent fraud. We hope, prevent error. Number 1, the separation of the custody of assets from accounting. Basically meaning, if I am the accounts payable person who writes the check to be paid, I shouldn't be the one that signs it or holds the checkbook. Now again, in today's society, we oftentimes will see that it's electronic, it's done on a computer, but again, if I'm the accounts payable person, I'm not going to have the custody of maybe the signature rights to sign that check. Separation of the authorization of transactions from the custody of the assets. Again, I'm going to approve a bill. I shouldn't be the one to cut the check. Separation of operational responsibility from the record keeping, meaning that the executive director of the organization should not have the ability to go into the accounting system and write out a check. Separation of IT duties from the user departments. Proper authorization of transactions and activities. So this is composed of both general authorization that management establishes policies and procedures and specific authorization. So again, I am working, let's imagine, for a department of accounting, and I wish to requisition for some textbooks that I need for research. The biology department should not be able to authorize that specific authorization. So again, there's specific authorization, there's general authorization. For example, if we are an accounting department that uses a copy machine, well, we're not going to authorize that. The college as a whole may general authorize that because it's one large contract. Adequate documents and records. There should be proper design of documents and records which include pre-numbered consecutively, prepared at the time a transaction takes place, designed for multiple use, and constructed to encourage correct preparation. Physical control over assets and records, just as it sounds. We have fixed assets, computers. Let's go with computers. Let's make sure we tag those computers, and we've got a separate log that shows what computers we have and where they are. Independent check on performance. Careful and continuous review of the first 4 control activities, meaning there should be an independent check at times. So maybe accounts payable enters in all the bills. And then at a certain point in time, somebody else will review those bills to make sure everything is recorded properly and accurately. I myself have done that in my career. When I worked for an accounts payable department, somebody would enter the bills and then I would check it over against those bills to make sure that it was done properly and that there was no data entry errors. Information and communication. The entity's information and communication system's purpose is to initiate, record, process, and report the entity's transactions and maintain accountability for the related assets. So again, information, communication, that's IT, information technology. Do we have enough information? Is there proper communication when a new software comes out or a new policy? We're living in a day of email and electronics, so theoretically, when something is going on, there should be some sort of a transaction that occurs whereby an email is sent to everybody with a new policy, perhaps. So everybody's aware consistently. Monitoring. Monitoring should be done to make sure all the control activities are in place. You would hate to find out that when we do an audit and we ask somebody, your accounting manual says you do these 6 steps. And the person says, what are you talking about? I do it in 3. We need to be careful of that. That's a good example of monitoring. The 4th objective. Explain how general controls and application controls reduce information technology risks. Now again, everybody in today's environment, with a few exceptions, please note, uses IT. Therefore, when we're doing an audit, auditing the computer is just as important as auditing those books and records. So technology can strengthen a company's system of internal controls, but it also does provide challenges. For example, IT controls will address the risks related to technology, and we generally have 2 of them. General controls, again, controls that apply to all aspects of the IT function, and application controls. These are controls that operate at a process level. So again, when we look at the general controls, generally, general controls talk about authorization, talks about who decides what software programs are used and for what purposes. Application controls talk about input, processing, output. Hopefully, when we put something into the system, if we put in an invoice to Staples of $300, the processing should enable us to see the same output when we get our transaction report for accounts payable. If we don't, then we have a problem. So when we look at general controls, again, 6 categories now. We have administration of the IT function, typically done by the board members, or, again, some newer titles, the CIO, Chief Information Officer. We then have separation of IT duties, which, again, should be separated into management, systems development, operations, and data control. And here's an example of how some IT departments do function today. We have systems development, which includes purchasing or developing software that meets the organization's needs, testing all new software to ensure that it is compatible with existing software, which may be done as pilot testing or parallel testing. Cybersecurity, big topic today because a lot of people are getting what's called hacked. So with physical and online security, we're talking about physical controls. Are we backing up our files? Are they being saved off-site? What about online access controls, which includes proper use of IDs and passwords? Backup and contingency planning. IT must have backup and contingency plans because those systems are subject to power failures, fire, excessive heat or humidity, and even sabotage. Hardware controls. These controls are built into the computer equipment to make sure we can detect and report any equipment failure, God forbid. Application controls. As we said, input, output, and processing. Those are the three big controls we look at here. Typically, when we look at a batch input control, three very interesting controls: a financial total, and typically that could just be a summary of, records in a batch that represent the meaningful, such as total dollars or amounts. So what could be a financial total? The total of all dollar amount paid to the vendors. What's a hash total? Again, meaning nothing. Hash total would be as if we have invoice number 1, invoice number 2, invoice number 3, that the grand total that should come out in the output is 6. If the output came out with 17, something is wrong. Another popular one, record count. The summary total of physical records in a batch, which is the total number of vendor invoices to be processed. Processing controls. Variety that we can do here when we're talking about processing. Sequence test determines that data submitted for processing are in the correct order. Completeness test, that every field in the record has been completed. So maybe you set up your computer that if you skip the employee last name, it flags you, doesn't let you go through anymore. You might all have that experience when you go online to try to buy something. Please complete this required field before continuing. The fifth objective, identify the types of information technology systems and their impact on internal controls. So again, the infrastructure can impact in several ways. First of all, we have the local area networks. Again, small cluster of buildings that usually have network capability. The wide area networks, again, larger companies, worldwide geographic areas. We have database management systems which enable companies to share information across several platforms. We as auditors need to get comfortable with this. ERP, Enterprise Resource Planning. That integrates many areas into one system. Companies also use firewalls, encryption techniques, and digital signatures to increase securities over IT. We also have service providers and cloud computing environments. That's another popular one. So again, as you can see, and let's not be misled that a 38-slide chapter is all on internal controls, but it is a very big popular area, ladies and gentlemen. It is important that we understand it. It is important as auditors we're comfortable with it, because if not, we could encounter severe problems in doing the audit. So again, we invite you to look at this chapter one more time to get comfortable with it, and then from there complete any and all assignments that you may have. Thank you again, and all the best.